Don Luskin, I'm reading your essay. That's really the bottom topic for this particular segment. Do we need rate cuts? If it weren't for the commercial paper market, which is shrinking and is dysfunctional and has caused a complete risk aversion, Don, I probably would agree with you. But because of the commercial paper mess, it just scares me to death.
Well, fair enough. And, we've got lots of dysfunctional markets out there. But I want to go back to a speech that Ben Bernanke gave in October of 2002, where he said that he believes that the best weapon for the Fed to deal with dysfunctional markets is not the Fed funds rate, which affects the entire economy, but the discount rate, which is a targeted surgical strike that comes in and helps financial institutions in distress in a specific way, rather than running the printing press, dropping money from helicopters, spreading it at random across the whole economy. You go to financial players in distress and you say, here's how we'll just help you. We'll be the lender of last resort, we'll prevent a run on the bank. That's exactly what the Fed is doing. It's working. There's simply no need to run the printing press and drop the money out of helicopters.
All right, to Don Luskin's point, the stock market is performing very well, even in the face of this money market risk aversion. That is a bit of a conundrum. Jerry, how do you see it?
They've priced in the Fed funds rate cut. So they've already assumed that we're going to have the Fed funds rate cut, and that's why they're rallying. I mean, look, Larry, for 2 years, we've seen the same pattern over and over again. When somebody says something or a piece of data comes out which indicates that the Fed has a greater chance of easing, the market rallies.
But wait, excuse me, Jerry, I just have to interrupt here because that's just factually wrong.
Right.
If you look at just the day-by-day data, we know what Fed expectations are because we can look at the Eurodollar futures markets. We can see day by day whether those expectations are deepening or whether they're narrowing. Every day that those Fed easing expectations get narrower, the market goes up. Every time those expectations deepen, the market goes down. That has been true 70% of the days since the high in the S&P. Now, when the S&P was at all-time highs, there were no rate cut expectations at all. Now that the S&P is off almost 6%, we've got 100 basis points of rate cuts expected. So how can you say that rate cut expectations are good for stocks?
We're going to come, Don, with it all, tumult, turmoil, financial credit, and all the rest of it subprime. We had a good August for the stock market. The American economy is definitely expanding. Profits are still rising, particularly sourced from overseas. One could almost say the Goldilocks bull market economy is alive and well. Could one say that?
I don't think one can almost say that. I think one ought to be saying that. Ever since this bull market started, it's been one thing after another. It's been hurricanes and high energy prices and income inequality and subprime mortgages. But the reality is the economy's been doing great. We've got a 4.6% unemployment rate, income's rising, spending's rising. What is really, really wrong? We're 6 weeks off of all-time highs in the S&P 500, off about 5%. Give me a break. If this is a crisis, I want a lifetime of crises.
Yeah, I mean, some of these broad indexes are up 7%, others are up 4 or 5% year to date. That ain't bad. Maria, that's the part of the puzzle that doesn't really fit.
You need some regulation so that the same thing doesn't happen again with these mortgage brokers, filling out the applications, falsifying information, and leaving other people holding the bag.
Not more regulation, not more regulation. We don't need another law. Stop me before I lend again.
All right, I like that. We end that on a
mortgage Starbucks.
On a great note of contention. No mortgage Starbucks. I like that, too.